This is JJ Hornblass, Executive Editor and Publisher of Auto Finance News, and I'm pleased to welcome you to this webinar, which is titled Boosting Direct and Indirect Lending Through Online Engagement. This is presented by the Center for Auto Finance Excellence, which is the industry resource of best practices and actionable advice for auto finance professionals. I want to start by apologizing for our technical difficulties in presenting this previously, but fortunately, and certainly thanks to Jim Landy, our speaker, we're able to present this as a pre-recorded webinar. This is the second in our four-part 2015 series of webinars, and it's presented by the Center for Auto Finance Excellence through the generous support of Fiserv, and I want to thank Fiserv for their support and generosity. We greatly appreciate it. During this webinar, we're going to look at best practices for online engagement with car buyers. How do today's online buyers purchase vehicles? What does that mean for lenders? Can lenders build trust with consumers without a face-to-face meeting? How can lenders keep time spent at the dealership at a minimum? Those are some of the questions we hope to address today. We encourage you to share the link to this webinar with your colleagues. The substance of this teleconference harkens to just some of what we do at the Center for Auto Finance Excellence. The center was launched in 2013 by Auto Finance News and Fiserv to benefit the auto finance community. We share content through events like this and at autofinanceexcellence.org, and we certainly encourage you to join the site and sign up for our email alerts. Our goal is to share unique content and insights on the practice of auto finance and to improve overall management performance in the industry. We add new content all the time. We've recently delved into monitoring dealer compliance, using data to improve the customer experience, and we've looked at underwriting and alternative lending. So there's a lot of great information there, and I hope you'll take advantage of it. With that, let's get started on this event. It is my pleasure to introduce our speaker, Jim Landy. First and foremost, Jim is an old and dear friend, and he has been at the forefront of innovation in auto finance for a long time, and we greatly appreciate his participation here. He is formally today the CEO and founder of PowerAutoLoan.com, which is an online platform to help buyers secure auto loans, and he is previously the founder and CEO of CarFinance.com, which grew during his tenure to 300 employees managing 50,000 active loans, totaling more than $1 billion of outstandings. In 1989, he founded Triad Financial, which expanded to more than $4 billion in outstandings during his time there. Triad, as many will remember, was sold to Ford Credit in 1999 and then to a consortium of investors in 2005. He also began roadloads.com while he was at Triad, and certainly there is, I would argue, no one better to discuss online engagement in the industry today. And now I'm really pleased to turn this over to Jim Landy, who will present on boosting lending through online engagement. Jim, take it away.
Thanks, JJ. Thanks for a great introduction. And it's my pleasure to be here today. So I've got 2 slides here to kind of go through and kind of give what I view as the current state of direct lending. So jumping right in, some highlights. Clearly most consumers are online researching and pricing their next vehicle. A little different than Indirect. Direct has several different what I would call acquisition streams. So in addition to the dealer purchase, you've got a private party purchase, and you also have the ability to refinance somebody's existing auto loan. With dealing directly with the consumer, the standard loan origination systems in the market available today really don't address the technology requirements in interfacing directly with the consumer. So there's a fair amount of technology investment required. And then need to drive traffic. It's really two camps: either you have it or you don't. So if you're a bank or a credit union, and you have a number of customers or members that are likely going to come to you and apply for their next auto loan, you're in a great spot. To the extent you don't, then clearly you need to get out in the market and drive some traffic, which I'll talk about in a slide or two. And then just quickly mentioning that it's a very big market. I think it just crested $900 billion. So there's a number of different subcategories to think about, and how each one of those categories will have a consumer that's probably going to approach it a little bit differently. So one way to look at it, break it down into some kind of a grid of new cars, luxury, non-luxury, used cars, and then looking at the different credit categories of the consumer. So on the top here, looking at captives, clearly they're going to continue to dominate the new car financing, which more than 1 in 2 today, virtually all of the leases. They're in a very unique spot as you look at the new car space. Some constraints around the franchisee laws, and certainly large organizations tend to not move as fast as others, but some really strong advantages. Very committed to the business. They have the scale to support the technology investment and certainly the resources. So you can see them in what I would frame as call it a hybrid model, where the consumer starts online when they're building the car, perhaps on the OEM site, and then applying, but then ultimately fulfilling that loan as an indirect at the point of sale. The remaining percentage of new is largely prime borrowers, and so again, you can see those consumers, to the extent they're interested in trying to get their financing ahead of time, going into their online banking suite and looking for a car loan. On the used car side, same kind of thing extends on the prime. And then the subprime consumer, who often is unsure of their credit situation prior to buying a car, you can see their experience really, having the largest potential of being enhanced by getting the financing in place prior to shopping online or at the point of sale. But certainly we know that 100% of customers today, before they go shopping at the dealer or online doing their research. So for those that don't have a customer base and are looking to drive some traffic, what we tried to put together here is a couple different of the categories, and tried to rank them in terms of where do you need a lot of scale, and maybe where you don't need as much scale if you're a smaller regional or sub-regional bank or finance company. But at the top, integration with the shopping site. So I'll have some more information on the next slide concerning this particular category. Affinity relationships. By that I mean, probably the best example would be an auto insurance provider that is looking to extend their relationship with their policyholder to include financing. So there, mostly you'll need to be a full spectrum player and larger scale. Then jumping down into advertising, online, offline, tends to be fairly expensive. You do need some resources either through an agency or internal, to manage the campaigns. Next being direct mail, which is, pretty efficient for a credit provider. You can do some, very specific targeting for your credit category, your geographic market, and fixed expense, certainly exists, but, a lot less than, those on top there. Then lead generation, a number of companies on the marketing side, have an online presence, and then once they have a consumer that has applied, then, we'll make that lead available to the marketplace. Little challenge there is that lead's also, attractive to a dealer as well as a finance company. So the pricing there tends to get bid up, to a point where the acquisition cost can be quite high. And then lastly, you can see the aggregator at the bottom, being probably the, requiring the least scale, and best example there would be a lending tree where, you can put your policy highlights or, broad parameters, and receive applicants that meet those. So it's fairly operationally efficient, although, not unlike the indirect model. The consumer is going to be presented with up to 4 offers. So certainly, your competitiveness and also the ability to respond real time is going to be important there. But looking at integration of, with the car buying sites, what I try to do here is just kind of give you, some of the top sites, and you can see the top three that I've mentioned here, Cars.com, AutoTrader, and KBB. Their strategy is to have, one lender in a, relatively exclusive position on their website. And you can see road loans for both AutoTrader and Cars.com, and then LifeStream, which is a division of SunTrust Bank on KBB. TrueCar is a little bit unique because a lot of its traffic is coming from affinity sources that are banks or credit unions. Best example would be a USAA. And then, mentioning Edmunds, their strategy is a little bit unique, just really offering sponsored ads, and most recently on their platform, as sponsors, you can see Lending Tree, Up to Drive, which is BMW's direct-to-consumer brand, and then ACE, Auto Cash Express, which is a lead generation company. So, looking at the dealer purchase category of direct lending, certainly there's an advantage to be face-to-face with that consumer at the point of sale. It's a pretty heavy motivation with F&I being, 20% plus of dealer profits today, and the finance reserve being, I think, about 2/3 of that 20%. So, pretty strong vested interest in retaining the financing. But there is some tension. I think, as JJ mentioned in the introduction on cycle time, you hear some of the larger dealer groups trying to get that in-store cycle time down to an hour, with finance probably being the biggest opportunity. Looking at it from the consumer's perspective, a lot more tools online. So as they're looking for their next car and shopping and comparing different vehicles, there's certainly a number of options to arrange the financing ahead of time, but also, with the action often involving 3 different transactions. You're buying a car, you're financing a car, and, oftentimes you're trading in a car. So there's really 3 transactions, and the third being the trade-in. Historically, there's been a lot of dependency on the dealer in that category, and there's a number of different solutions. So there is an opportunity for the consumer, to get the other 2 components worked out and really simplify the transaction to that single purchase of the car from the dealer. So all of those tools are probably not as available to everybody, but I think if you're savvy on the tech side, it's a natural way to shop. So we're probably in that early adopter stage for somebody to disintermediate these conventional dependencies, but you can certainly see it growing. Looking at borrower expectations, consumers don't buy cars every day. 3 or 4 year cycle, and the average age of the car is increasing, partly because of the demand crush from the Great Recession, but also people are just giving their cars longer, they're lasting longer. So their comparison to buying a car is buying a book, registering for a hotel, or buying an airline ticket. So they're going to expect real-time decisions, very responsive, certainly competitive pricing, and the transparency about all of the components, what's really going on here. That is historically not existed, but certainly has a lot of value to the consumer and is being brought to the market. And I thought I'd just quickly mention a recent survey that KBB did, when a consumer answered positive that they're interested in getting their financing prior to the point of sale, and broke that down. As you can see, it's perception, not necessarily reality, but 80% thought they'd be able to obtain a better rate than going to the dealer, and then you can see roughly 1 out of 5 thought it would be more convenient or they would save time. And then 1 out of 10, there was a trust issue and thought it would be better to keep their information private and getting everything arranged prior. Certainly, direct lending is the regulatory favorite. Some of the the communications we've seen from the CFPB has really been complementary to direct. There's no markup, so the whole disparate impact goes away. From my experience, delinquency is lower and has less volatility, and the consumers generally have fewer complaints, which is also very positive. And the fact that it empowers the consumer is very much in line with the mission of the CFPB. And then you're hearing more and more about the Department of Justice looking at dealer fraud, predominantly at this stage, used car dealers in New York. But the direct lending obviously eliminates that component from a lender's perspective, and a lot of the prime activity, the lenders are going to be holding that risk. And then the newer marketplace models, which is consistent with what we're doing at Power Auto Loan, providing a lot of transparency into the loan characteristics for investors interested in those loans. So a little bit about us. We're building a brand new platform from the ground up. Specializing in the category I've been involved in for a couple of decades now, the subprime borrower, which is about a third of the transaction volume in the market today. And as I mentioned earlier, from a traffic perspective, we're building this to integrate with prime lenders. So prime lenders that have traffic, although their policies are constraining their ability to approve a subprime consumer, what we've developed is a way to seamlessly integrate into that process and offer the consumer a very friendly and positive experience. All the decisions will be real time. The initial pull is going to be a soft pull or using pre-screen technology. So in the event we can't help that consumer, there's no impact to their score. There's no additional adverse action communication required. The platform is being built for omni-channel, but specifically with mobile, with more and more consumers leveraging their mobile device process, and it's something that they can carry into the point of sale. And then at that point of sale, we can present their note and security agreement, and they can sign electronically on that mobile device. So pretty slick, pretty convenient, and very empowering for that less than prime consumer. So that's what I had today. Hopefully that was helpful and informative. And JJ, if there's anything I missed, let me know. Happy to answer some questions.
Yeah, no, that was great, Jim. I really appreciate it. I thought I would maybe just follow up your presentation with a couple of questions, if that's okay. And you mentioned early in the presentation about the different kind of sub markets within auto finance, and I understand that Power is focusing on the subprime market, but maybe you could distinguish, kind of handicap the other facets of the auto finance market for direct lending. For example, new versus used. Does it work better in, or is it more beneficial in one versus the other? What kind of guidance you give us on that?
Yeah, I think the new is largely going to be dominated by the captives, and again, I think from my view, they have the advantage or the advantages that I mentioned. So I think you can see or expect them to develop some pretty attractive customer user experience on the technology side, and new cars are a bit more of a commodity depending on what subcategory, as long as you're not in that ultra luxury or exotic. Used cars are kind of interesting because you can help the consumer provide a little bit more transparency in terms of what that is worth, and value their trade-in, which they'll likely have, and really try to put all of the components of the transaction together. So it's a little bit more work, but a lot more value for the consumer.
Right. We've been watching the blooming of these alternative lenders. I'm sure you've taken note. Lending Club, there's just Funding Circle. There's just a whole range of them. LendKey, which is one of them, has particularly taken an interest in the auto finance space, although not solely. What's your sense for this sort of burgeoning class of lenders as it relates to the existing set of direct auto finance providers, and even maybe perhaps even just a kind of auto finance broadly?
Yeah, well, it's very consistent with what we're doing at Power Auto Loan. So our intention is not to be a balance sheet lender, but to originate and service for institutional investors largely in that call it marketplace model. What I understand is if you look at the Lending Club in particular, certainly they're the largest in the space, and their demand from an investor perspective is 4 or 5 times what that platform is originating every month, every quarter.
Right.
So probably largely around the QE and where interest rates are, and just the hunger for yield. I could certainly see this becoming a bigger component of auto finance as well. The uniquenesses of auto, where you have a secured transaction as opposed to unsecured. Unsecured is relatively easy, but it's interesting if you look or compare and contrast the credit characteristics of a prime unsecured to a subprime secured. The loss rates are actually the same, because of higher frequency, but a lot higher recovery as well. So you could see that investor being fairly attracted to that segment. Certainly there's leverage is available for auto just because of the long history of the performance there. So I think it could be pretty interesting.
Yeah, I'm just struck I'm just struck with the volume of investor capital flowing into, through that channel, and you got to figure that that hunger for product will eventually make its way into the auto space in some sort of measurable way. I mean, I agree with you that some of the traditional finance providers are going to maintain a good amount of share, but boy, there's a lot of capital flowing through that side of those startups.
And there's, the other thing is, the teams and the advisory boards and the board of directors of a number of the companies, you can look at in the fintech space, are very bright. You see a lot of MIT, Carnegie Mellon, Stanford grads. They're looking at alternative data. They're approaching the market with, a much more transparent, borrower-friendly approach, which I think is going to have a lot of appeal, right? So that's the other component of how the crossover could really impact the auto market.
Right. One thing that you didn't mention in your presentation, I'd love to get your feel for it, is the sort of mobile online dynamic. I was reading recently that I think it's something like 30% of auto shopping these days is done via mobile device, and that the growth rate for that portion of the market is just kind of going through the roof. 40%. One. I mean, I'm sure you've got. There are other such surveys, but one I saw was something along the lines of like a 40% year-over-year growth rate. How do you what's your take on that? And are you thinking about that as how are you thinking about that as you're building out Power Auto Loan?
Yeah, I mean, we're thinking about mobile first. PC and tablet, second and third. I think TrueCar just announced, their first quarter earnings, and their expectation is in the very near term, 50% of their customers coming to their site are coming to mobile. And we saw, in my most recent experience, some pretty high growth rates from PC or tablet to mobile as well. Mm-hmm. And it really, if you think about it, it fits. We're much more aligned with the the subprime consumer who may not have the PC or the tablet, but certainly has a smartphone. So more and more, that's where people are going to go. Certainly the millennials, the phone is more of a valued component of their life than the car. So it's just how they interact. So for all of those reasons, I think it's very positive. But also the dealer purchase aspect, being able to take the phone into the dealership to the extent you've built up some brand equity with that borrower or consumer, mm-hmm. And you're coming into the store with them. Certainly mobile helps that experience as well.
Yeah, I saw a fascinating data point, Jim, which is, and this surprised me, 61% of car buyers, when they're at the dealership, access their smartphones. This is meaning while they're there, checking prices. And so I think about that data point, and you had that kind of waterfall of traffic. Is it different? How is it different when you're thinking about mobile, or does it sort of hold up also for that channel?
I think it holds up, and again, depending on how rich of an experience you're intended to you're planning on providing. If you're helping the consumer with again, not only the loan, but helping them value their trade-in, see what that equity impact is on their overall buying capacity, perhaps even helping them select the car. And so you're giving them full transparency into the overall transaction. However, once they get to the dealership, if they do the test drive and for whatever reason they don't like the car as much as they thought they would, or they saw another one right next door, and they move from car A to car B, you need to be able to have the ability for that consumer to update that information, provide the dynamic pricing, and populate the note security agreement real time. So that's where mobile can really one of the ways that can really just be the deciding factor in your conversion and retention rates.
Right. If I can ask you one last question, Jim, if that's okay, I'd love to
Sure.
Just learn a little bit more about Power Auto Loan. I see that today, it's May 13, and the site has yet to go live. When do you have any sense for that? And also would love to hear, kind of keeping with the spirit of the Center for Auto Finance Excellence, if you could just talk about the development process of how you kind of went about developing Power Auto Loan. Did you seek venture funding? Are you just kind of broadly the process of building out the business and the platform? Be great to get some high level sense from you for what's gone into the development of Power Auto Loan.
Yeah, be happy to. So as you kind of mentioned, I've been doing this for a while. I think there's a confluence of events happening in the market today. We've talked about the marketplace lending model, talked about more tools for the consumer online, and clearly, to me anyway, there's a big change happening or about to happen on the retail side. So I think it's a really interesting time to take a step back and look at what the consumer experience will could ideally be, and leveraging technology and other data sources to really make that experience convenient and intuitive for them. So we basically mapped out the flow for all of the different what I would call categories. So dealer purchase, independent, franchise, private party purchase, refinance, and we're building all of that technology from the ground up to one, deliver real-time responses, and have a user experience that's intuitive for them, since it's not something the borrower, the consumer, does every day of the week. So we have just kind of completed the design process, and we've also locked down a number of our key strategic partners and vendors, and now we'll start coding. So at this point, we're just about to go out and raise our first round of capital. We'll probably start doing that in June, and that will kind of carry us through to the launch, which we expect to be probably in the late fourth quarter of this year, and then start to ramp in 2016. So again, it's built to be an integrated model with a prime lender, and to the extent that the prime lender is interested in this space, but doesn't have the scale or the resources to develop the platform, then we're certainly open to white labeling it for them, and again, just originating and or servicing for them on the prime quality borrower.
All right. Well, it sounds great, Jim. Best of luck.
Thank you.
And and thank you very much. I'm really happy that that we were able to do this, and we're super appreciative of your presentation. This is this was the end of the event from the Center for Auto Finance Excellence, and all of us here at Center remain committed to bringing quality content on best practices in auto lending and leasing. And I hope you'll visit us at autofinanceexcellence.org and also share a link to this teleconference with your colleagues and friends. Please be sure to keep an eye out for future events from the Center for Auto Finance Excellence. And of course, I want to once again thank our partner Fiserv for their support in making this and other center endeavors possible. This concludes the telecast, and thank you all so much for your participation.